Good day, everyone, and welcome to this week's Business and Investment Tips program, a production of RCCG Christ Church Radio with Ayodeji Ebo, an investment professional. This week focuses on Nigeria's Q1 2024 GDP report. Last week, the National Bureau of Statistics (NBS) published Nigeria's first quarter gross domestic product (GDP) numbers for 2024. The Nigerian economy grew for the 14th consecutive quarter since it exited recession in 2020. Real GDP rose by 2.98% year-on-year in Q1 2024, lower than 3.46% year-on-year in Q4 2023, that is, versus Q4 2022, and higher than the growth of 2.31% year-on-year recorded in Q1 2023. The suppressed growth rate in Q1 2024, January to March 2024, relative to the previous quarter, October to December 2023, can be attributed to naira devaluation, higher interest rates, and constrained purchasing power. GDP tracks how an economy performs and measures the value of all final goods and services produced in an economy in a given period, usually a quarter or a year. Real GDP reflects the actual value of goods and services produced without the influence of price movements. Simply put, the GDP of a sector can be affected by both the volume of goods and services produced and the respective prices. Nevertheless, what's important is the increase in goods and services produced rather than the price increases. Nigeria's GDP report captures 19 sectors, but only 5 sectors account for 71.1% of total activities in the economy. These are agriculture, 20.8%, ICT, 18%, trade, wholesale and retail, 15.5%, manufacturing 10%, and financial and insurance 6.7%. The non-oil sector, which has been the primary driver of Nigeria's GDP growth since Q4 2020, accounted for 93.6% of the GDP in Q1 2024 compared to 95.3% in Q4 2023. It recorded a growth of 2.8% year-on-year in Q1 2024, trailing the 3.1% year-on-year growth in Q4 2023. The services sector showed impressive growth at 4.3% year-on-year, an improvement from the 4% growth in Q4 2023 and the highest growth rate since the 2020 recession. However, the agriculture sector saw a significant drop in growth to 0.2% in Q1 2024, narrowly avoiding a negative growth rate at 2.1% in Q4 2023. Similarly, the industry sector struggled, growing at 2.2% in Q1 2024 compared to 3.9% in Q4 2023. On the other hand, improved security efforts have started to yield positive results in the oil sector as oil production volumes increased to 1.57 million barrels per day in Q1 2024 from 1.55 million barrels per day in the fourth quarter of 2023. As a result, the sector grew by 5.7%, albeit much lower than 12.1% in Q4 2023. Based on the contribution of the sectors to GDP, the services sector picked up momentum at 58% in Q1 2024 versus 56.7% in Q4 2023. And industries improved 20.9% in Q1 2024 versus 17.3% in Q4 2023, while the contribution of the agriculture sector moderated 21.1% in Q1 2024 versus 26.1% in Q4 2023. Now, here are our takeaways. 1. 16 out of the 19 sectors expanded in Q1 2024, save for the construction sector, administrative and support sector, and other services sector. The negative growth rate in the construction sector may be attributed to the depreciation of the exchange rate and rising prices of materials, slowing down activities in that space. 2. The rebound in the oil sector was sustained 5.7% year-on-year as the effort of the new administration to curtail crude oil theft yielded positive results. Crude oil production rose 4% year-on-year and 1.3% quarter-on-quarter to a 2-year high of 1.57 million barrels per day in Q1 2024 from 1.55 million barrels per day in Q4 2023 and 1.51 million barrels per day in Q1 2023. 3. The agricultural sector struggled in Q1 2024, 0.2% year-on-year, narrowly avoiding a negative growth rate. This further buttresses the high food inflation rate over 40% as of April 2024 due to continued insecurity in the major food-producing states. 5. Nigeria's nominal GDP, which reflects the impact of inflation, rose by 16% year-on-year to 60.3 trillion naira in Q1 2024 from 51.9 trillion naira in Q1 2023. However, it declined 10.9% quarter-on-quarter from 67.7 trillion naira. This shows that the expansion in economic activity is driven by inflation and not volumes. 5. The depreciation of the naira, which led to the increase in building costs, resulted in a slowdown in real estate growth to 0.8% in Q1 2024 as developers adopted a wait-and-see approach to avoid buying materials at a high cost. 6. Growth in the ICT sector slowed, albeit positive, 5.4% for the fourth consecutive quarter due to the slowdown in growth in the telecommunications and information services subsector, which moderated to 6.2% year-on-year in Q1 2024 relative to 6.9% in Q4 2023. This can be linked to the FX volatility, which may affect capital and operational expenditure as well as constrained consumer wallets. 7. The financial and insurance sector's growth came in stronger at 31.2% in Q1 2024, the best annual performance in 21 years on the back of FX adjustment, which boosted earnings in the form of FX revaluation gains as well as expansion of loan books in naira terms. 8. Growth in the manufacturing sector improved to 1.5% year-on-year as only 4 oil, refining, textile, motor vehicles and other manufacturing out of the 13 subsectors closed in the negative relative to 7 subsectors in Q4 2023. The devaluation of the naira and the higher interest rates curtailed the growth in this sector. 9. The trade sector growth softened for the second consecutive quarter to 1.2% year-on-year in Q1 2024 compared to 1.4% year-on-year in Q4 2023 due to the devaluation of the naira at the official window, which increased the cost of clearing imported items, leading to slower demand. The sector was also impacted by higher interest rates. We expect Nigeria's GDP to sustain its growth path. GDP growth is projected to cross 3% in Q2 2024, bolstered by a lower base effect as oil production is expected to remain around current levels. The continued huge spending on data and voice will support growth in the telecommunications sector, while higher rates will support growth in the financial sector. On the other hand, the unabating inflation rate, naira devaluation, and expected higher energy prices, petrol and electricity, may continue to constrain the non-oil sector. Also, the higher interest rates, which will lead to higher finance costs for the manufacturing sector, may impact the profitability of the companies. Thank you for listening. Please join us same time next week for another interesting and insightful session. For questions, comments, and feedback, kindly forward to ebo.ayodeji@gmail.com or send an SMS to 07082 463747. Stay blessed.